Last of our tutorial, let's make a kind of summary of past, present and future, a mixed salad and hopefully a tasty one. Outlook. 1975, reinsurance industry was a well-established, traditional, specific one with its own techniques, expertise, distribution channels, individual risk assessment, claims processing. There was a clear distinction between risk cover, that is, financial consequences of damage to a property due to a sudden, unpredictable accident, and what was not insured, such like non-damage BI. More than 80% of covered assets were tangible ones. Top management members of reinsurance companies were seniors having developed solid insurance competencies, whatever their studies. Today, the reinsurance industry has turned to be part of the financial world, with intricate relationship between the respective actors, competitors, and partners. Power at the top has shifted from insurance specialists to financial ones. The risk-averse mindset of societies has grown both at the individual and corporate levels, and opportunity and a challenge for our industry. This attitude has reached the insurance companies who want to secure stable results, and lately, reinsurance companies and their investors, due to negative return net of capital cost over the last 5 years, and 2022 won't be different. Volatility not paid for the risk assumed, increased handling, modeling, ERM, ESG, IFRS, and retrocession cost. Retrocession market is small, about $16 billion, to face big cat events, drying out, and more expensive for the rest available. Fears that the worsening cat loss trend, not cat with climate change, but also man-made, uncontrolled accumulations. Pandemic, cyber, political violences, SRCC will continue. The favorable environment to invest money at a time interest rates were low or even negative has gone. Our insurance industry is at the crossroads. Insurance is now a value-destroying industry. Half of insurers are not earning their cost of capital, and half are trading below their book value, according to McKinsey Report 2022. At the same time, there is a massive opportunity out there, and if we capture it, we can double our industry. Demand is increasing. Risk awareness gains ground due to increased claims frequency, severity, and medias. Natural disasters losses grow year by year, average, frequency, and severity, along with the urbanization and concentration of values, the climate change, the disruption of social behaving and values. Emerging risks appear and or develop dramatically. Cyber, non-damage BI, and even in US, ASEAN cover. As an industry, we should not complain about the demand for an increased role. Offer was increasing with the development on top of the regular growth of the traditional market of alternative risk solutions offered by non-traditional investors, but not enough to cope with the increased exposures, and now starts to decline. Protection gap has been widening. $220 billion on the cat property, source Swiss Re, $588 billion in health, $41 billion for pension, source Moody's graphic. The challenge is insurers' inability to provide adequate cover at an affordable price. More demand, less offer. The usual answer is price increase. Insurance companies have raised their prices for some years, especially for commercial lines. Reinsurance companies have started slowly, but the trend up is on the go. These price increases are bound to continue. Players have to face inflation and social inflation, two threats: increased frequency and huge severity potential, with scenarios going beyond our worst movies scenarios. Increase in prices and reduction of cover, cyber, is not the answer expected from clients. Reinsurance industry must face the challenges presented by systemic risk and increase its footprint or run the risk of losing its relevance in the next decade. Insurance industry weight is down. Penetration ratio expressed as a percentage of worldwide GDP, down from 1.3 to 1% for P&C commercial lines over the recent years. Over the last decades, insurance premium has grown by 3.2%, while global GDP annual growth was 4.7%. Surplus dedicated to reinsurance, more or less $600 billion, depending on metrics, are not growing anymore. We're even down over the first 6 months 2022. While Andrew, a $15 billion event in 1992, would reach $70 billion today, and even if striking Miami, $200 billion according to KCC. COVID-19, nearly $50 billion insurance cost, third reinsurance loss, with hardly any premium for it, but no image reward for our industry. Pandemic risk is by nature worldwide, but who had forecasted it could affect so many lines of business, life and non-life together? Unexpected accumulated losses have impaired balance sheets, distressing investors. A substantial part of this amount has been claimed, paid, although the purpose of the contracts was not to cover this risk. Court decisions, considering lack of clarity of policy wordings, have often been made in favor of insured. Insurance industry has most of the time enjoyed decision in its favor, but despite the size of losses paid, got a bad image in the public. We have to change that. Solutions? Reduce acquisition and management cost to allow affordable risk premium. Invest massively in new tools. Use AI, ML, share big data, streamline processes to allow for fast-track risk handling from pricing, underwriting, delivering the contract, assessing, and paying the claim. Hire high-skilled profile to innovate while preparing redundancies on the other hand. Cost reductions and a more efficient treatment will allow for a proper risk premium to be accepted by the clients. Design clear wordings. What is covered, what is not. Named perils would be nice to have. What could be covered provided additional premium. Clarity reduce litigation costs, thus price needed, and improves the image of our industry. Work on risk prevention rather than pay after the loss, pay to prevent it. Our industry has to contribute to change the mindset of citizens and corporates who have turned too much individualistic and short-term minded. Incentives may help this change with discounts on homes equipped with devices that can detect fire, flood, or unwanted visitors. McKinsey Report 2022. Follow an ESG responsible approach rather than short-term money earning. Increase the cooperation between the respective actors of our industry. Join resources for think tanks able to exchange with governments. Solutions for systemic risks can only be found if we work together, attract capital as an innovative, risk-taking and controlling, yield-providing industry. A challenge, but there has never been so many opportunities and talents to work on this. Reinsurance industry with limited capital cannot answer to unlimited requests. Attract capital to take more risk rather than give the money back to shareholders because of insufficient return. To do that, there must be an adequate price for the service offered, with bespoke products and return for the risks assumed. Our industry has to let understood and appreciated, in other words, to sell better to the public, the value of the services offered and the price needed for this. In case of systemic risks, private-public partnership may appear needed beyond and or some do exist for long, like for the earthquake cover for homeowners in Japan, nuclear and terror pools, and Nat Cat covers in some markets, France, Japan, Spain, UK, US. World Bank has produced innovative parametric solutions, sometimes involving several countries with different triggers. Other solutions may be offered by the market depending on variety and size of the risk. We know how difficult it is to find a country-by-country solution, not to speak of 27 European countries. We experience it with pandemic issues these days. Our reinsurance industry's mission towards citizens and corporate is to offer solutions according to its financial capacities and be rewarded for it with the proper return deserved. It may sound like I have a dream, but that's a pretty challenge to work on. I have done my duty with passion over the last 47 years servicing our reinsurance industry. Now it's time for me to say goodbye, and thanks for your attention.